So our next speaker for this morning is Paul Simons from Pyrford International. Paul is actually an Oxford graduate and a CFA chart holder and a master's, and I could probably go on as well. So he's a member of the investment Stratcom at Pyrford International, and he also heads up their ESG initiatives at the firm. Pyrford managed the Net Group Investments Global Cautious Fund, which is a max 40% equity fund. And basically what they're trying to do is deliver stable real returns over time with much less volatility than the market. Paul, good morning, and over to you.
Good morning. Thanks very much for that introduction, and good morning to everybody else. Thanks for joining me today. I'm going to spend a few minutes running through slides talking about how the portfolio has performed over the last quarter, and then I'm very happy to take any questions you have. So just to keep in mind at the outset here, the mandate that we have with regard to the Global Cautious Fund is to generate a steady stream of real returns over the long run, and to avoid, as far as possible, capital losses in the meantime. And that's what we've been focused on in running this portfolio and similar portfolios from here in the UK for the last 30 or so years. So if I turn to the first slide here, talking about performance. Over the last quarter, markets were a bit more subdued. Equity markets in the third quarter were far less strong than they had been earlier in the year, and we saw a significant turn in bond markets. They're the only two asset classes that we take exposure to with this product, and that means that during the third quarter there was actually a negative return, a mild negative return, and I'll explain what produced that. What we've seen over the third quarter is a significant shift in the outlook for inflation around the world, and that's had an impact on bond yields pretty much everywhere. Our view has been for a long while that bond yields were far too low, irrespective of inflation, but that wasn't a widely held view, and plenty of other investors were prepared to take the sorts of risks with types of bonds being held that we weren't in respect of duration. I'll explain a bit more what we mean in a moment. So if you look on the table here, you can see non-US dollar bonds, so bonds in places like the UK, Australia and Germany, outside of the base currency of this fund, generated a significant negative return, or a meaningful negative return. US bonds didn't, and the difference here is the currency exposure. So we have a very short duration target with the bonds we hold. They are very close to being cash because we think the risks of holding longer term bonds when yields are as low as they are now is not something that we're prepared to take. It's what we would describe as return-free risk. Yields are almost zero, below zero in some cases, but price movements when yields start to go up can be fairly significant. If you consider the German 30-year bond at the moment has a yield of 0.2%. It has zero coupon, so you don't get any income at the moment, a yield of 0.2%. If yields increase by 1% on that bond because of the duration, because of the length of time over which you'll be receiving, well, over which time you'll have to hold the bond, you won't be receiving anything, then you'll lose nearly 24% of your capital from investing in a bond like that. And that's a similar story with long-term bonds elsewhere, which is why we think that we need to preserve capital in short-term, very low duration bonds. That's what's in the portfolio. The average duration of the bonds that we hold is 1.1 years, so very close to being cash. Now, when there's no currency effect, you can see in a period like we've just experienced when yields start to rise, that they preserve capital very well. So the US bonds have a very marginal positive return here. The non-US bonds, because there was a currency effect, they're negative. In terms of the equity part of the portfolio, we performed better in the US than we did elsewhere. Markets were somewhat choppy, and given the return of inflation, meaning different things to different companies, it's more subdued. No clear theme in the equity part of the portfolio. The types of stocks that we own are very sort of cautious in their structure, their business models and their balance sheets, so they're not exposed to interest rate costs going up. but equally they haven't been the types of companies which have benefited from interest rates being as low as they have. So a slightly choppy period there. Moving on to currency, and I think that's best explained by looking at the following slide here. So we have a rule in the portfolio that we'll have no more than 45% of the assets exposed to foreign currency which isn't hedged. That's a rule we apply to this fund and all other similar ones that we run in other jurisdictions. The US dollar, we think, is one of the most overvalued currencies in the world at the moment. We use a technique called purchasing power parity analysis, which is a bit of a mouthful, and I won't go into the details of explaining it, but it's a way of assessing whether one currency is expensive or cheap in relation to another on the basis of the differences in wholesale inflation in those places. It's a technique we've used very successfully over 30 years, and that's what drives our currency decision here. So because we think the base currency of the fund, the US dollar, is expensive, we have the maximum amount possible outside of the US dollar, and that's shown up in this period when the US dollar was strong as having a negative impact on currency. So you can see the exposure to the Canadian dollar, the euro, Swiss franc as well, were all drags on performance. However, we did hedge the Australian dollar. That's to avoid having too much overseas exposure, and because the Australian dollar fell against the US dollar, that has shown up to be a positive here. Now, perhaps we'll talk a little bit more later about what we expect for currency movements, but for now, let's move on and talk about how we see markets. We've been pretty cautious in all the time that we've been running the fund, but we're more cautious now than we have been in the recent past. Equity markets have performed exceptionally strongly over the last 18 months, driven by a combination of unprecedented monetary stimulus, and this time, and this is distinct from 2008 and 2009 in the global financial crisis, unprecedented fiscal stimulus as well. We've had the two combining, and that has led to markets reaching levels of valuation which we simply don't think can be justified for very long. Incidentally, we went into the COVID-related crisis with markets expensive, just not as expensive as they are now. So these two charts show the PE index, which is the sort of pinky orange line of the MSCI World Index, and then the performance of the index. The chart on the left shows over the last decade or so. Chart on the right shows exactly the same data, but for a shorter period. So PE has dropped a little bit recently, but the index certainly hasn't, and PE is well above where it was pre-COVID. So if you think the economic outlook looks better than it did immediately before anyone had heard of COVID-19, that would make sense. It doesn't make much sense to us. This is a different way of looking at it. This is the dividend yield of the equity index versus the index performance itself. Dividend yield to us is a more reliable signal of value than PE. It's not subject to interpretation or accounting rules or assumptions made by company management. It's based on the cash you receive in your bank account if you're a shareholder in a company. And for the MSCI World Index, that has never been lower. So the pink line going up is plotted against the axis on the right in both of these charts here. So as the pink line goes up, it means dividend yield is falling, and it has never been lower than it is now on this index, which we think is a bit of an alarm signal. This is also an alarm signal. Now, this measure is Warren Buffett, the well-known long-term US fundamental investor. One of his favorite, originally his favorite. He's sort of stepped back a bit from saying any one measure is his favorite, but nonetheless, it still has a very useful indication in our view of the valuation of markets. This looks at the value of the US stock market against the US economy. The average is the blue line. We are well above 2 standard deviations above that at the moment, so extremely overvalued in terms of any sort of long-term history. So for the time being, we have relatively modest exposure to US equities, and then overall the lowest exposure to equities that we've had in the time we've been running the fund for you. And until better value returns to equity markets in general and the US in particular, that's where we'll have to stay. So for the time being, this is still a period which we think need to ride out, preserve capital, and deploy it more aggressively when valuations justify that, as we have in the past when we've been running these funds. Now, within the equity market in particular, there's been a bit of a divergence between performance of what are commonly referred to as growth stocks and the sort of quality and value names that we focus on in our portfolio. So I describe quality and value as being business models which have a proven track record of generating sales and profits from a business model which isn't easily copied by others, might have some sort of protection in terms of intellectual property or access to resources or land, that sort of thing, and that grows perhaps slightly faster than the economy that it operates in, but not necessarily at huge clips, as some growth stocks are. Growth stocks are those that have dominated the headlines. They're what everyone wants to talk about when they're performing well. Excuse me. We typically don't have those in the portfolio. Their track records are unestablished. They often rely on repeated rounds of funding. They typically don't pay dividends at all for many years. Nonetheless, those types of stocks have performed particularly well over the last couple of years, supported by interest rates being as low as they are, and they have been. When you have a business which is going to generate its profits, if you're lucky, sometime into the future, being able to discount those at very low interest rates allows you to justify high share prices. So that part of the market has performed particularly well, but we think may face some pressure as yields continue to rise, which is what we expect them to do. Just by some indication here, the German 10-year government bond has a real yield of -4%. So the only way that you can make money by holding that is by selling it to someone who thinks that's good value. In all other scenarios, you're going to lose money holding that. And even if inflation falls, so the real yield falls or improves because of that, we still think fundamentally yields have further to go, which is going to put pressure on these types of growth stocks and hopefully create opportunities for the perhaps more well-established but perhaps boring stocks that we have in the portfolio. I said we were more cautious now than we have been at any point. This chart shows the equity weighting, which is again the orange-pink line plotted on the right-hand side versus the ACWI, the MSCI All Country World Index over the last 2.5 years or so. As we went into the COVID crisis, we had 25% in equities. As markets collapsed, we had no choice but were comfortable increasing equity exposure. That's what our process drives us to do. When value is returning, the right thing to do is to take more exposure to the asset class, which we know over the very long run performs the best, but it only performs the best if you buy it when it's attractively valued. So we did that. Our intention was to do more, but you can see from the very sharp V-shaped recovery in the green line there that value was merely glimpsed. It didn't stay around for long. So by June of last year, we felt that the only prudent thing to do was to reduce that equity exposure, having made a lot of money from the increased exposure. And then when we got to January of this year, having made a bit more money on what we still had at 25%, decided that we needed to reduce that to 20, which is where we have been since. So we're waiting now for an opportunity to put money back into the equity market when valuations support that. Portfolio as it stands now looks like this. So a very significant allocation to government bonds with short duration. So assets which, I shouldn't say impossible, assets which it is very difficult to lose money in, waiting for the opportunity to switch into assets which it's currently eminently possible to lose money in, overvalued equities. We do have equities in the portfolio, so 20%, a significant allocation to Asia, which we think across the world has the best long-term fundamentals, lower levels of debt, better internal reinvestment into industry from savings, better demographics, and better valuations in many respects as well. Plus also exposure to some of the higher quality and most attractively valued European names. The bonds you can see there, as I described, are all very short duration, so very little exposure to risks of losing money as interest rates go up. And then the last thing I'd draw your attention to just today are the characteristics in the bottom right here. These apply to the equity part of the portfolio, but they're what we think are always important to be keeping in mind when building an equity portfolio. So stocks that we hold have a dividend yield of 3.4%, so that's significantly higher than the universe as a whole. They have much lower levels of debt, so the companies that we invest in rely much less on very cheap debt now, but might not remain very cheap. And despite having a lower reliance on debt, they generate significantly higher returns than the equity that they have, which is what you earn as a shareholder in a business. So we think that the stocks we've bought for you are cheaper, higher dividend yield, less risky, lower levels of debt, and yet more profitable. And they're the ones we're trying to find around the world in the research that we're doing. All right, I'll stop there. Very happy to take any questions that anybody has. Thanks very much.
That was great. Paul, thank you so much. It was actually a very comprehensive presentation. And I say comprehensive because we actually got in so many questions for you. But as you went through the slides, you actually ended up answering pretty much all of them as well. So well done times two. So thanks very much for your time, and we'll see you next time.
Okay. All right. Thanks very much. Cheerio.
Thank you, Paul.